Hello, everybody, and welcome to the latest webinar on behalf of Holborn Assets. Let me just introduce myself to you. My name is Malcolm Bell. I'm a senior associate here with Holborn Assets. I'd just like to take a couple of minutes to tell you a bit about Holborn Assets. We're one of the largest advisory firms in the world. We have offices in Europe, so London, for example, the Middle East, Dubai, Abu Dhabi, and the Far East, and indeed South Africa. We're a family-run business. We've been in existence for over 24 years. Be assured, we are fully regulated in every jurisdiction that we have a presence and an office. Personally, I have over 22 years industry experience, helping individuals grow and protect their wealth, help and protect their accumulated wealth over many years. Let me introduce you now to Brian Smith. Brian has been working with me on this webinar, and he'll also tell you a little bit about himself, and then we'll hand over to Lauren Ireland. Lauren is frankly the star of the show, and she will tell us all about the gasworks in York. Brian, all yours.
Thanks, Malcolm. Like Malcolm said, my name is Brian Smith. I've been working with expats across the world for many years, too many to count at the moment. But currently I'm in Europe. I've worked in the Middle East and in the Far East. I've got to say that it's a pleasure to be presenting this opportunity today with Lauren. It's something that comes across our desk occasionally, which is slightly out of the ordinary, as this is. We started planning this webinar about 3 weeks ago, I think, Malcolm, something like that. And a lot has changed in those 3 weeks. The world is a totally different place now. So I think now to look at a class like, an asset class like that we're looking at today, it would be a very good home for people to invest in.
Thank you, Brian. So Lauren, over to you. Folks, people who are online, thank you for taking time out to join us. And Lauren's open to questions as we go. Also, you have the chat facility online. Please post your messages and questions if you prefer to use that option. But as I say, Lauren will, or just raise your hand, and Lauren will answer the questions, as indeed we will if there are relevant questions more towards financing, etc., at the end, which we can pick up on. But for the time now, I'm going to hand over to Lauren. Lauren, the floor is yours. Thank you very much.
Thanks, guys. Really nice to be back. It's always nice to present to Holborn clients, and I think Brian hit the nail on the head. Obviously, a lot's changed in the last 3 weeks. But as a property person for the last sort of 20 years in the UK, I've always had the question from my clients. Well, actually, I've had to ask them, are you more driven by yield or capital appreciation? Because not many times do you get a city that reflects both, that actually ticks both boxes. But what we've seen in this particular city of York is a certain macro dynamic, which has given us a really robust investment case, because I think compared to a lot of the product out in the market, and that has been the usual suspect for many years, they've been based around commercial cities that are about sort of hustle and bustle, and people need to be based there to work there. And I think the pandemic has changed people's minds. It's made people think about their health and their happiness, their wellness. And I think the likes of a world war potential, or, you know, the likes of Russia, Ukraine, this tension makes people think about those things. Where do I want to be and where do I want to base myself? So what we have in the city of York is more of an aspirational type location, more of a Bath or a Cambridge or Oxford over the likes of a Manchester or a Liverpool or Birmingham. So because of that sort of change in people's mindset about the types of locations they want to be, investors have also started to refocus where they want to invest as well. And that's why we have a really compelling case here. So I'm just going to go through some slides with you to show you sort of the key features of York itself, and then the investment case in the gasworks. So first and foremost, it's an award-winning city. So this is from the Sunday Times, and obviously when a big hitter like the Sunday Times comes along and says this is the best place to live in the UK, they really mean it, and people start to take notice. So they did that in 2018. And it's a large criteria list. It's not just sort of a finger in the air and someone saying it's a really nice place to go and visit. There are many sort of factors that go into this, and this is lifestyle and affluence and macroeconomic factors and safety and health, etc. So as you can see from some of the awards there, it's featuring time and time again. It's not at the #1 spot at the moment. And the only reason for that is because it's become quite affluent. It's one of the most affluent cities in the north. And it's obviously less affordable than some of its regional cities. So that's sort of only good for the city. Moving along to that, the increasing affluence, it's been quite important to note. Now, if you think about 333 boroughs in the UK that we have, this is a study that was done by Savills just last month in terms of the trajectory of people, wealthy people moving between cities. And these are the numbers. So the number of £2 million houses or properties in the city of York has tripled in the last 3 years. So it's number 10 in terms of movement of people and shifts. So it just shows you that the city is becoming very, very affluent. Location and connectivity, it's always been a really important location in the UK. It's equidistant between Edinburgh and London, so it's 1 hour and 45 minutes on the train from London direct, and you do see a lot of people doing that journey now. It's also down the road from Leeds, which is a large commercial hub. You've got a lot of insurance and legal business within Leeds. So I think it's the second biggest legal destination in Europe, based in Leeds. So what you have is the likes of, for example, if somebody has to work in London, but doesn't necessarily want to raise a family there or live there, they might commute 20 minutes out to Kent or Surrey or Hertfordshire. And that's what you have in the likes of York and Leeds. You've got this really massive hub of commerce in Leeds, but people don't necessarily want to base themselves there. So they will commute that 23 minutes down the road every day. And 23 minutes is obviously just probably half of getting my commute, my old commute across London. And also in Leeds, you have the airport, which connects you globally, just 23 minutes down the road to 80 direct destinations. And then in terms of connectivity, which has become more important in the last couple of years, or more, sort of at the forefront of people's minds, how fast can I connect to the world? It's the UK's first gigabit city, which means it's the fastest broadband in the entire UK when it comes to the entire city. So everyone can connect 100 times faster. So that's every single destination, every single residential apartment, every single commercial space within York has access to that. So that's all really good for the city. So you'll see a lot of technology type businesses setting up because of that. Supply and demand. So this is one of my favorite slides, because I like to look at numbers, and I'm an investor myself. I think when you look at a city and you go to invest in it, it's all well and good looking at these big property houses making their forecast for the next 5 years. But what happens after those 5 years? Is there a massive supply pipeline coming? And am I going to see that sort of natural sort of trajectory, or those peaks and troughs that I don't necessarily want to see in massive waves within a city? So you need to look at areas where supply and demand is really, really outstripped. So what we have here is one of the worst housing supply shortages in the UK. It's a low-rise city. Nothing can be built higher than the Minster, and it's completely circled with a wall. So very, very little development. There's only a couple of brownfield sites left within walking distance to the city, and the planners are very, very careful to keep that dynamic of the York city that was of old as well. So what we have, because of these sort of real severe shortages, you've got a compounding effect with people's movements in the last 2 years, with people flooding into the likes of these cities. So it's only compounded that shortage we already had that existed. So safety in the city, you've got in the UK a national crime rate of 96.4. So that means every 1,000 people, there is 96.4 incidents, and that's minor to major incidents. York City is a third of that. That's the police statistics. So one of the lowest rates in the entire UK, and it also feels like a safe city. So short break visitors, staycationers. It is the UK's #1 staycation destination, and it feels like that as well. So when you think about safety, you also need to think about investment. So you and I might not live in the city where we invest, but we want to make sure that obviously people want to live there. It's a nice place to live. So you've got that low crime rate in one hand, and you want to make sure that you've got the resilience to these national house price movements that you see sort of every 7 to 10 years. So combine that imbalance of supply and demand, high occupancy levels, and that's where you get that resilience. So history and tourism, it's a major historical city. It's the third most visited city in the UK. Like I say, completely walled, really important in the UK history, British history. And obviously people, when they come to visit, you want to go to a city like this. You don't want to go to a big commercial city. You want to go to somewhere that's got some British history behind it. So you've got a massive amount of tourism. So 8.4 million visitors go through York every year, generating, and it's over £800 million of tourism spend now. So as I mentioned, it's the #1 staycation place within the UK. And obviously those international visitors, when they come, they want to go there as well because they want to learn about the city. Just some photos here to give you an idea of what it's like. There's a lot of sort of cobbled streets, lovely little tea houses, delis, coffee shops, bars, restaurants. Gastronomy is massive in the city. So it's got a really nice feel to go away for a weekend. I was there in November for my friend's wedding. And I was staying in this little guest house called York Minster Guest House. And there was a couple there that have been back 47 times from Norway, just because it's just a really lovely place to go and stay for the weekend. So education, obviously you've got to look at education when you want to look at investment cities, because those are the people that are going to, in a lot of cases, stay and rent these apartments and then move on. So you've got about 25,000 university students in the city, and the two major universities compete with Oxford and Cambridge in terms of biotech and science. So cancer and malaria research are really high in terms of their global recognition in this city. And you'll see a lot of those students stay within the city because that sector has become quite important. Bioscience sector is massive in York. And that comes off the back of the UK becoming the UK's founding science city. It was York, and it was named that in the 80s by the government. So what they did every year is just start injecting money into the city. And it's done a really good job because it's now got sort of world-leading companies setting up shop there off the back of the universities that are doing great research. In terms of the economy, Yorkshire, and this obviously captures Leeds as well, but York itself as a city is quite a powerhouse. So you've got £110 billion going through Yorkshire every year. And to put that into context, that is bigger than 11 of the EU countries in terms of their output. So really, really strong, that one section of the UK. And that's why you see Yorkshire and Humber is always up there in terms of growth. It's one of these places within the UK that's been understated for a long time, and now it's really come to the forefront, and we see all these really great numbers coming out. Off the back of the types of businesses you have in the city and those universities that we have there, you've got a really highly educated workforce. So a lot of these people have 2 or 3 degrees to be in those industries. You've got high wages, low unemployment, really low unemployment against a national average of 4.2. So you've got 7,500 businesses within the city and only 200,000 residents. So really, really strong on all fronts in commerce for York. Now, this might look like a weather map. It's not. It is Savills forecasts, property forecast for 5 years. And this puts obviously the Northwest and Yorkshire and Humber up there at 18.8% over the next 5 years. So some nice strong figures. We had it sitting at 28.8% this time last year. And then over the last year, it's grown 10%. Bang on what Savills predicted, 10.2%. I think the Halifax had it at. So we're looking at some really good, strong numbers here. I think some big property houses put a finger in the air sometimes and put out some really, really high numbers. But we've got to think about what's going on in the world right now. And obviously supply and demand in a city has a lot to do with making these numbers sustainable. So I just wanted to extrapolate a couple of these numbers here for you. So we've got obviously London. London has suffered a lot, obviously, since pandemic. There was a huge pent-up amount of, well, a huge amount of supply that was not eaten up, let's put it that way. Prices went through the roof, and people sort of moved away from the London and are thinking, well, why am I going to go for a 3 or 4% yield in a city that's not going to give me that capital growth when I can go outside it for a fraction of the price. So over the next 5 years, London's about 5.6%. The only borough in London that's going to do anything with any sort of numbers is going to be Kensington and Chelsea. So that's prime central London. And that's sort of, entry price at 2.5–3 million. So well out of reach for your average investor. Across the UK, we're looking at 13.1% growth. So still an okay type of growth after a big sort of spin on property last year, after that pent up sort of Brexit and COVID demand. But Yorkshire there is very strong, obviously at that 18.8% over the next 5 years. So the gasworks, that's why we're here. This is the most luxurious project in York. York's not seen anything like the gasworks before, and it's on one of these sites that's sort of beautifully positioned. It's very central, and it's got a huge amount of outside space. So if anyone's been to London, you probably think in your mind Hampstead or Islington in terms of greenery. Heworth has got Heworth Green, which is where the gasworks is. It's got golf clubs, the golf club, tennis courts, coffee shops, that sort of thing. So a really nice feel. Lots of green open spaces, really high in digital excellence, and that goes along with the type of city that we're talking about. We've got short lets permitted on the head lease, which also very, very important for the type of city we're looking at and the demand there. Our prices, so we've got a few of the city suites left at 230,000, and our one beds are starting at 295, and then we've got completions from early next year. So just to give you an idea of sort of where we are, the city of York, and if anyone's been there, you'll know you can walk around the city wall in an hour and a half, and you can walk across the city in 25 minutes. So it's not a massive amount of area if you're looking inside the wall. And so most of the development is on the outside of the wall. So we are here in Heworth Green, which is only 6 minutes to the city wall, and that map doesn't really do it justice, because it is quite a spread out city, but there's a lot of suburbs and things like that, and we're just looking at the central area here. But to sort of break it down a little bit more, this is the old moat, so this is where you'll see the city wall along here, York Minster on the right. Our site is here. This isn't a live picture, obviously. The cylinder's gone now. But that is our corner site. So that walk, that bottom corner into the city there through Montgate, is about a 6-minute walk in heels. I've done it, and I'm 5'2", so probably shorter for you. There are Victorian and Georgian houses along this journey, which is where your tenants or people that stay in your property would walk to get to the city. And I think the journey is always important. You have to think about, you can have a great development, but there's a really nasty bit in between that and the city. It's not. It's a nice row of Georgian and Victorian houses, and they're fetching between 900,000 to 1.5 million. So quite high values for a northern city. Okay, so this is our site. We've got 5 blocks, 215 units, as I mentioned. It's only a 4-story build. So you've got 2 zones. Zone C here, these 3 buildings, actually everything's going to complete at the same time now. So zone C and zone A, it doesn't really matter. The specification within the development is all the same. The only difference is you've obviously got a few different features. So in zone A here, you'll have a raised garden, and you'll have concierge services within that building. In zone A, you've got an acre of green space for residents and an edible garden over here, but people have access to both. And these are the types of amenities we're looking at. Where you are based and where I'm based, these are all probably commonplace, other than the edible garden. That's unusual. I think it's quite a nice touch, actually. But in York, to get all this in one development is unusual. So the developer's really sort of pushing the boat out and doing something different here. It's an eco-friendly development. So you've got 1 cycle space per resident underneath the building. It's completely circled by the bicycle tracks that go around the city. It's a nice path that goes through the development. And then you've got a car and cycle club on site as well. So Curate is the, let's say it's a digital ecosystem. So it's everything that your tenant will need to run their life at the development. So they can liaise with concierge, they can arrange for deliveries, they can order food. there's affiliate type marketing within the app that they can access and get sort of perks for using that. They pay their rent through there, bills through there. For landlords, for investors, particularly overseas investors, it's really nice because it's very hands-off and you can look in at any point in time and see how your investment's going, other tenants paying the rent on time, what's coming out, and it's got yield appreciation tools on there, so you can keep an eye on things from a distance. So this is one of obviously the things that you're keen to know about, the rentals. What are my returns going to be? So buy-to-lets in the city are around 5.5%. So on par with a lot of your, your Manchester, Birmingham type regional cities. But where we've seen a real extended case or an enhanced yield opportunity is accessing the short letting market. So if you remember the slide I brought up with regards to history and tourism, we've got 8.4 million visitors going through the city every year, and you've only got about 5,000 hotel rooms. So there's about 52 hotels, and most of them are small guest houses, and not many of them have more than 100 rooms, even 50 rooms. So there is, if you think about an occupancy rate, how many days there are in the year, there's a massive undersupply of short-term lets. So because the hotels can't fulfill this need, what's needed is short-term accommodation. So you'll have a lot of Airbnb, booking.com type accommodation coming through, and the values are very, very high. So it's not uncommon to get £125, £150 a night for a high specification property within the within the city. So that's all nice. Those yields would be looking at sort of 12 to 14%. But what you can't do if you're an investor, most investors look to gear their money. You won't be able to access that market if you want to get lending, because lenders don't like to have occupancy shortfalls. They want to know that that contract is there and that rent is going to be paid every single month. So what you need is access to this market, but you need a long-term tenant to do that. And what we have is this amazing solution, which is a company called Croft Living, who are service department operators in that space. And what they'll be doing is going out there. Their model is akin to Airbnb, and they will be renting out to tourist and corporate lets. They will obviously be capturing, your 12 to 14% gross yields, and they have a profit margin to make. But what they're going to offer is 7% net yield back to investors that will give them access to their properties for 5 years. There is a 3-year break clause, so if you would like to exit that contract after 3 years, you can do so. But it can also be sold with the benefit of the lease. So that's a company tenant in there paying your rent to you or your mortgage provider from day one. So there's no void period. So it's a really nice, strong opportunity. And also by signing a contract with Croft at the point of exchange, which is what you do, you sort of remove yourself from going into a development where if something like this doesn't exist, all the investors are competing for the same tenants at the same time. You've got a development of 200 flats completing, and sort of 60 or 70 of them are to tenants. There's naturally going to be a decrease because everyone's trying to rent their property at the same time, and probably just reducing it a little bit at a time to make sure you get that first month's payment. So you don't have access to, or you don't have the need to be exposed to that by signing with Croft. So North Star, these guys are Yorkshiremen, been developing in the city and other northern cities for about 20 years now. They do commercial and residential development. So the pictures here are some of the developments they've done in the city. This is the Malmason Hotel, which is the most recent one. They've also got, the Gasworks is their biggest residential undertaking at the moment, but they've also got the Roman Quarter site. So that is going to be an incredibly big offering, but that won't be completing till 25, 26. So 650 mixed use apartments in the Roman Quarter there. So that's a really nice undertaking that North Star are undertaking. Did I say undertaking twice, Malcolm? I think I did. But yeah, no, the idea is that these guys work with the local authorities. They see a need for housing, and they see a need, and they always want to better their city. They're Yorkshiremen, like I say, and they want to do what's right and make it bigger and better. And that's what they're doing with these types of developments. So it's really simple to reserve. It's £2,000. So you talk to your wealth manager, obviously. We select a unit and you reserve with £2,000. Your exchange is 20%. minus that £2,000, and you complete with 80%. The lease length is nice and long at 250 years. Ground rent's £250 a year per annum, and that is capped. And your service charge is only £2.67. So if you sign the deal with Croft, they will be covering your service charge. So that is one extra charge that you won't be exposed to for that 5-year period. So that 7% really is a true net yield. So we'll go through a cash flow in a moment, and I'll show you how that works. But before then, this isn't a 5-year illustration. So we have access to a number of mortgage products on the market, and Holborn have done a lot of due diligence with some mortgage firms, brokerages, and we've got a panel of lenders. Mortgages at 70% for overseas investors are quite usual, and we're looking at 4%. It's slightly less than that now, but obviously with inflation and what's going on, we're expecting those mortgage rates to move. So we're sort of upping those a little bit to 3.99 to provide some contingency there. So on an entry price of 230,000, the equity required would be 86,642. That's exchange and completion monies. So in terms of your returns, you're looking at 60 months of £806 net cash flow. That is obviously the amount you receive after the mortgage, generating 48,360, plus your capital growth that Savills is predicting there, and that is your return over 5 years. So your cash on cash in 5 years will be 106%. And I've actually got a cash flow here. I'm not sure how people's screens look, but is that zoomed in enough, Brian and Malcolm? I'm not sure.
No, not for me anyway.
Right, so what I'll do is I'll exit out of the presentation. I'll go into a cash flow, and then I can zoom it in and show people if that's helpful. And before I do that, I'll just show a 5-year illustration of a 1-bed, which is 295,000. So you'll just see, I'll just go back. The equity required on the 230,000 unit is 86,000. And then obviously it's that slight bit more, but it's only around 13,000 extra at the point of exchange to go for the 1-bed. And obviously that 7% is all relative, so your returns are looking at that. So let me just come out of the presentation, and I'll bring up a cash flow so we can make it a bit clearer for everyone. So there's one there. So this is the suite, and I'm just going to zoom it in. There we go. Is that any good?
Yes, that's perfect, Lauren.
Thank you.
Great. Okay. So as I mentioned, we're looking at a mortgage with a 70% loan to value and a 4% interest rate. Payment on reservation is your 20%, 46,505, and the breakdown of that is here. So 20% at exchange, some conveyancing fees. Now, the conveyancing fees at this price point are around £1,400, but the developer has got an incentive at the moment where they're contributing £995 towards that. So your shortfall on conveyancing is only 305 there. So your exchange monies are £46,500. And then obviously on completion, down here in section B, your final capital payment to make up that 30% deposit is 10%. Your stamp duty, and this is assuming you're not resident in the UK, is 13,600, some lender arrangement fees. So your balance at completion is around 40,000. So all in, the equity on this particular price point is 86,000. And this is your net cash flow. So monthly income, that's 7%. £1,342 is 7% of 230. Minus your mortgage costs, which is 535, and that's a really nice healthy cash flow of £806 per month for 60 months. Now, the only other thing I would normally add here at completion is a furniture pack. So that would normally for a city suite be 3,600. For the 1-bed's nearly £5,000, and that is also something the developer is running at the moment for Holborn clients. So I've not included that in your cash flows here. And that's till the end of the month we've got access to this deal. Ordinarily, we'd also have to add service charges and some management fees, but because Croft are essentially managing their own product and they're paying the service charges, this is not having to come out. So it really is a true net yield of 7%. What you need to consider is obviously your mortgage payments, and it depends where you're based in your own situation, but you're still looking at a nice, healthy sort of £806 on that entry price unit. So yeah, I think it looks quite good there. Is there anything else I can sort of talk about here on this, Brian? What do you think?
No, I think it's very clear, Lauren. There's no hidden costs at all. Everything is mapped out here. You've gone through the figures. It looks very, very professional, I've got to say. Very good.
Yeah, I think so. And I think, like I mentioned at the beginning, it has been difficult to find cities where you can achieve that capital growth and that yield. You can go to Halifax and get an 11% net yield, very well and good, but you won't get any capital growth out of it. London, you used to be able to get, really, really nice, healthy capital growth, and people would sort of stomach the lower yield for the purpose of that. But you really can't get even that anymore. So to find a city and to still have access to a city with such extreme macroeconomic, supply and demand issues, I think it's kind of ticks the boxes.
Yep, I think you're absolutely right. It's very rare we come across something that giving us such a healthy return on yield and capital growth. You're absolutely right. Clients normally have to choose between the two, but in this case, and this is what makes this one special, we have it both ways, as well as the guaranteed 7% for 5 years is absolutely enormous driver for this.
Yeah, exactly. So I'll stop sharing that now, and if there's any sort of questions, I mean, obviously after the presentation, obviously you wealth managers are there to talk to the clients, but I'm available to sort of follow up if you need me to supply cash flows and all of the due diligence. I've got some really nice reports on sort of the backing up the investment case. Essentially, I think there's a lot of people out there presenting certain cases, but I've got a lot of evidence to back it up, which is really nice to know as well.
Okay, is there any, I haven't got any questions come up. I haven't seen anything. I think you've covered everything admirably, actually, Lauren. Very well explained. I didn't see any areas that are grey at all. Obviously, we can arrange mortgages for overseas clients. We've been doing this for many, many years, so that's not an issue at all. Any other question? Is there any questions at all?
I think over the course of my webinars, I've managed to pick up all the questions and put them into my presentation, so I have less and less questions every time I do it.
Oh, it's very clear. I haven't got anything at the moment come up, so
no problem.
Yeah, it seems like you've explained everything. And as I said, we're here to help clients. We're available. If you have any other questions that you didn't want to raise at the moment, you've got our contact details, so we're happy to answer them, and we can even arrange another one-on-one directly with Lauren. I'm sure she won't mind that.
No problem. Yeah.
Lauren, would you mind just dot the I's and cross the T's on the Croft Living offer that expires at the end of March? I'm sure for those people who are interested and are thinking, this isn't a question of pushing, but it's a question of there is an offer on the table. It's been on the table for a while, and it is coming to an end. So I think it's just quite important just to dot the I's and cross the T's on that, please.
Sure. Yeah. So Croft as a company, they had in mind a certain number of units that they wanted to take on this basis. And we're getting close to that number. So they've sort of said to me, look, we know you've got some webinars coming up. We know we've got some Holborn clients and some other clients that are interested. We're happy to sort of honour that deal till the end of March, but they will be removing it at the end of March. At the same time, the developer is offering in another hand a free furniture pack and a legal contribution, and we've got the 7% from Croft. So the deal's never going to be as good as it is now. So anybody that reserves formally before the end of March will sort of lock that in.
Yeah, no, that's fantastic.
Perfect.
Thank you.
Yeah.
And for those people online, can I just mention, I mean, Brian and I have been recommending property as an asset class for, gosh, some would say too long, 15 years, I think each of us 15 years. And we both know that when the big boys, and in this case, it's Savills, actually quote a number, in this case, 18.8% over 5 years, we know that that's a cautious number, because when it's Savills or JLL or Knight Frank, it doesn't matter who it is, they want to be able to show that in 5 years' time, well, guess what, guys, we actually over-delivered. It might be 20, 22. I'm guessing because I don't know, because I'm not that clever. I can't foresee the future, but we do know historically that these numbers that are presented as a forecast are always on the cautious side. And as much as Lauren is quoting, understandably so, 18.8%, and nothing, as the last 3 weeks have proven, nothing in life is guaranteed, then I think you can rest assured that the returns are likely to be substantially better.
Yeah, I think to point out there, that's a really good point. The forecasts are for Yorkshire as a region, and York City, which sits in the middle of that region, has this major supply demand dynamic, this housing crisis, which is actually going to be obviously helping to push the numbers up. But you've got other areas that don't have that. So essentially, those figures are very, very low for the city of York, average for the Yorkshire region, encompassing Leeds. But I think it can only mean that that's going to be higher for the city itself.
Indeed, yeah, fantastic.
Yeah.
Thank you. Okay, well, if there are no further questions, Lauren, Brian, any last thoughts you'd like to add?
No, only that like Lauren, I did visit York just before the pandemic in 2018, and it's the first time I've actually stayed in York as well. I passed through it before, but I was in the Lake District for a while, and I went over to York and stayed there for 4 or 5 days. It is a fabulous city, absolutely fabulous. There's so much to see. And Lauren touched on, the museums, the York Minster Church, the walled city, the cobbled streets. Oh, it's just amazing place.
Well, I hope you went to Betty's tea rooms whilst you were there, because that's just simply world famous. It's just the best place
really
to go.
Yeah,
of course. Okay, I think that's
the
it.
Gasworks York, a perfect combination. Capital growth, 18.8% over 5 years, probably higher, with a 7% net yield. It's a perfect combination, and we hope that you've enjoyed our webinar today, and we'll be in touch with you all very soon. And thank you very much for your time. Thank you all.
thank you.
Thanks, Lauren.